Welcome back, ICA. What we want to go over next here is going to be talking about the tickers that you're going to be looking at. So, some of us may already understand, Tesla is TSLA, or SPY, or the S&P index has SPX and SPY. But I want to clarify a lot of these, either misconceptions or beginner mistakes here. To start off, we got to talk a bit about the tickers. In turn, some of these numbers are a bit outdated, but what I want to focus on here is really the colors that I've set up here. So the ticker label, all right, there's going to be multiple ones that mean the same thing. So here, what I've done is I've grouped them together. Okay, and here what we want to understand is each one has a different purpose. Okay. You can understand that the marketplace is, Wall Street is a place to trade at, and there are going to be hours of operation, business hours, and then aftermarket or closing hours, or, a bit of it you can understand is almost like a nighttime marketplace. The 24-hour marketplace have these ones and exclamation marks at the end of them, you'll notice, all right? And what I want to point out here is there's four main tickers in terms of the market that we're going to focus on here. The first one being the S&P index, Standard & Poor 500. We've already shown and charted a little bit on SPX, right? But SPX, you'll notice here, SPX trades in the thousands, same with the futures. But SPX is the cash, if you were to go invest in those 500 companies that are in the S&P 500, it would total up to become this basket of stocks, okay? On the ETF side of it, the SPY is the tradable managed fund that you can imagine, is handled by a company called the Spider, okay, SPDR. In addition, what we have are different ways to picture the market, all right? The S&P 500 is the top 500 companies in terms of size. The Dow Jones Industrial is going to be all of our industry, so you can think of the construction and the materials and that type of industry. They get included in that basket of stocks. You have a couple different ways to imagine, but I put a star next to the ones that are going to be the tradable options that we want you guys to be looking for, and understanding that these each give a different picture of a different sector. So again, you got your industrial on the Dow Jones. Your NASDAQ is known as, here we use QQQ, which is Invesco's product, QQQ. And NASDAQ is the technology sector of the market. So you can imagine Apple, Tesla, Microsoft, NVIDIA, those types of companies. And then here what you have is the Russell 2000, which is ultimately the 2000 small cap companies. And, depending on, these two are based upon by size, Russell and S&P 500, while the NASDAQ, is a sector of specific type of technologies. Dow Jones is, specifically the industrials. Now, we always want to go back to our understanding about the marble jar. The marble jar is going to be our way to understand that each one of these comprises of different marbles, right? Different companies represent the different marbles. And every jar is a different way of participating in different sectors of the market and different, having different risk to the market, you might imagine. Now, in addition, we have to understand that there's a couple of tickers that are also directly related to the markets. Okay, the way that money works is, the money is printed, people have the first choice is just to hoard it. I like to think money under the mattress. Leaving it in just dollar bills, you can understand with how inflation works, over time, this becomes worth less and less. And so that's why, tax code and the way that the system is set up, incentivizes people to put their money into different situations, okay? You can imagine one of the options is the treasury bonds. You can go and purchase from Uncle Sam himself, get what's considered a risk-free rate. You lend them your money, and as a result, you get a paid interest, on a consistent basis, depending on what type of bond you purchase. On the other hand, you can go and participate in the market. So I like to use SPY or the S&P 500 as the best gauge of the market as a whole. But again, participation in the market is where, your people are looking for positive percentage gains over time, because leaving it in dollar bills is going to be the negative one, okay? There also is obviously the option of putting into real estate. Understand real estate is a sector of the broader market. So you can understand that even these different companies, Vanguard, Charles Schwab, iShares, etc., they have different tickers that actually help you invest in their basket of real estate companies. Okay. As a result, you got to understand the way that these three are linked together means that as one goes up, the other goes down. So if the market goes up, or dollar goes down, etc., the way that interest for these bonds work is that it goes up until people are enticed to go put their money into it, and then that's where it kind of balances out. So money's always going to flow to where the lowest risk, okay, let me write that down, highest reward. Lowest risk, highest reward, okay? So there was a period of time recently where people were getting their money out of the markets and starting to put them into the dollar, and then eventually looking for their bonds, because the bond interest rates have started to rise in such a significant way that these bonds are actually very enticing as well. So these different tickers, we'll also take a look at them in our charts in a moment to understand how they actually have connections to each other. Let's continue. Now, ETF. What is an ETF? ETF is an exchange traded fund. Understand this is a managed fund, okay? They're businesses, okay? Their purpose is to make themselves money. They wouldn't exist otherwise, right? They're offering a product to the public. They're taking a fee as a result. They have an expense ratio that is taken out every time that their specific ticker is actually traded. So they get a fee out of it, okay? So remember this, they're there to mirror, okay? So for example, here, SPY is trying to mirror what SPX is doing. The Dow Jones DIA is mirroring what the DJI is. So these are companies that are watching that and trying to maintain a tradable fund for you guys, right? They created a product and they're scraping off the top there. So keep that in mind, okay? They're tracking something for you. And in this situation, let me go on this next page. In this situation, they are actually helping manage by buying and selling for the holders of their specific ticker, okay? So for example, if you're in SPY, that business here is trying to balance out. So I've got a couple screenshots over time of different, all right, this is all Apple. This is Apple, 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 but you see they're adjusting the weight relative to their ETF according to what can maintain the parallel to the SPX, okay? Same with IWM, QQQ, we use the 3 QQQs. And you can think of, there's the financial sector, there's the energy sector, there's, semiconductors and oil. There's different tickers that are all designed to track different sectors. And as a whole, there's the big broad market one, right? So SPY, also in the SPY, they have different sectors that they are also invested in, okay? And those comprise of what SPY, the trust ETF, is doing. Now, why is it important for us to understand this? Well, the marble jar again. You know, if they're holding a marble jar with 100 marbles, well, that means in this situation, Apple is anywhere from 6 to 7 marbles in there. And that's actually quite a bit of, you know, investment in Apple. That's quite a bit of money that they put in there. And the way that Apple moves is directly going to affect SPY more so than the ones that have smaller percentages. And these are always changing and adjusting. And a part of what is nice about ETFs, or these indexed funds, is that they're really helping take care of the monitoring of the markets. These are more so mostly for people who just kind of want to put their money in there and let it be. And because you are paying that expense ratio, you're allowing somebody to take care of that management for you. There's these things that say, depending on your expense ratio, how much it is over time, it really starts to cut into profits. But for somebody who is, doesn't want to monitor something, it doesn't want to monitor the markets as a whole. Mostly people who have, full-time jobs aren't doing this as their day trading job. Ultimately, that is a good exchange in many cases. All right. But the point that I want to make here is that everything that we're dealing with is designed as a business, right? It's a business of ETFs. The marketplace is, they're handling businesses and the values of businesses. And also businesses, slash people are always trying to figure out where the best return of their money comes from. So I want you to keep those things in mind. It's very important to know not only what tickers to focus on, but also the fact that there is monetary incentive behind the movement of stocks and the gathering of them as well, okay? Last on the slides here, I do want to point out is that each of those tickers that I gave you, you got to be careful with them, especially when you're typing them in. There's going to be situations where an extra letter before or after sometimes will pull up what's considered a leveraged equity or a leveraged ETF. What that is you can think of it as like a multiplier, where in regular QQQ, if it moves 1%, this guy, TQQQ and SQQQ are going to be multiples of it. So TQQQ here is actually going to match it by 3%. So every 1% gets multiplied by 3. And then the short version, meaning they expect it to go down, that's going to get multiplied by -3. So this will make money. The short version will make money when the price goes down of that particular tracked stock. If this at this point is a little confusing, please let me know. You're not going to be the first one to have to ask about this. We will talk a little bit and compare these charts in just a moment. So let me go and we're going to switch over into my charts. Give me 1 second. Okay. I'm just going to hide the extra stuff for now. We don't need all this on here. What we're going to talk right now about is how these things move with each other. Okay. We're going to chart two things at once. On the top, I'm going to have the S&P index. I'm just going to go and put this in. Let's do the last 5 years. Okay. We're going to take down here. The first thing I'm going to put up is the dollar index, DXY. Okay, the dollar index. What this is going to do, and we'll pull up the same 5 years to compare to this. is that, like I said, money is going to move opposite of each other. So this should, right, if you see the white line here, up and down, it's going to match up the whole way through, meaning that they're matched up for the time frames, okay? So here is a very big picture version of it. As one goes up, the other goes down. Let me enlarge this a little bit too, right? Okay. And here, going all the way here, that had a little bit of stability. There's going to, the rise of this also started to cause this to come back down. It's not always going to be a direct one-to-one. Let's go a little bit closer in this. You start to see it a little bit more. Let's go into year-to-date here and year-to-date here. There we go. That shows a little bit more. So obviously, there's going to be areas where it's not going to be direct one-to-one, but here you can see a little bit better of, you have this go up, this came down, right? They had a little pop here, that's where this came down, okay? Up, down, right? So you can notice how they move opposite of each other, all right? In math, it's called an inverse relationship, INVERSE, inverse. They're inverse to each other, meaning as one goes up, one goes down. So if the value of the dollar starts to go up, people do look at the index and say, well, maybe I should pull some of it out, right? And it's the vice versa. As it goes down, they look to say, hey, I'm going to put it into something that can gather more value because they move opposite of each other. In addition, I know I didn't talk about this necessarily in the slides, but I do want to introduce you guys also to the VIX. The VIX is, the standard deviation of the index, but it's also a situation where you got to understand also moves opposite and inversely to the markets too. So here you have the same type of situation, right? Let me match it up a little better. Yeah, I was using your, there we go. Okay, so there we go. Yeah, that pop here, drop, that's where that matches up here and here, here and here. So again, the VIX is another word for the VIX. Because it is a standard deviation, what you can imagine is that if price only fluctuates here by about 20, that's a small range. When it fluctuates by about 30 to 40, that's a large range. What would that mean? Well, what that means in terms of the VIX, or what that means in terms of the volatility index, volatility of the S&P index, means that low numbers means there's stability. People are more confident of the prices. Higher prices mean or higher numbers on the VIX mean fear. People are less certain of the prices, and therefore the ranges or the standard deviation starts to rise. So another way to think about it in the mathematical sense is price tends to like to stay in a certain range, and when it starts to break out of certain ranges that it's been respecting, it starts to raise the VIX, because the VIX is going to create or calculate the fact that the standard deviation is getting bigger. In terms of the basketball example, you can almost imagine if that, like, if Steph Curry was averaging 25 a game, and all of a sudden that range that he was averaging, scoring usually it's maybe, let's say 20 to 30. Let's say he scores like a 50-point game, right? or suddenly drops down toward that 10. What that ultimately does is it breaks new numbers, right? Breaks out of previous expected ranges, and that's going to signify, hey, something's changing here. And that's what the VIX does. The moment the VIX starts to pop is when prices generally start to relax, when they come back down, because they're inversely related. All right, in addition, let's do this too. I'm gonna do well, this already is SPX. We're gonna do the SPXU, okay? Ultra Pro Short S&P 500. What does this mean? I want you to think about this. So this is another situation where you can notice this is moving exactly opposite, right? Let me adjust that a little there. There we go. Exactly opposite of the movement above. So just as if there is the SPY index that's going to track this SPX, this is SPXU, which is Ultra Pro Short. So for every time this goes up, this is going to go down 3 times the amount, okay? Now, the graph itself gets really weird as you pull out further and go toward like years in going back. The reason being that they're constantly readjusting this, so this is naturally going to fall down. Okay, that's just like a mathematical when you deal with these types of monitoring these markets and you're trying to create a product that goes opposite of it, there's this natural decay to it, okay? But I wouldn't necessarily worry so much about this decay. This isn't something that you put your money into hoping that it's going to go up over time, okay? It's naturally decaying. It's also leveraged. So for every 1% that SPX moves, this is 3% in the opposite direction. Just to warn you guys to avoid these situations, but also when you do put in your tickers, just be very careful not to add that extra letter on in there, okay? Let's pull up TNX. TNX here is the 10-year treasury note yield, right? Just like for a business, if a business is worth about 10 to 15 years of investment in terms of that PE ratio, what you have here in your TNX, which is your 10-year treasury yield, you can notice again, also moves a bit inversely to these previous prices, right? I'm trying to match up that. There we go. Okay. So you have a couple of these things that all move inversely. You've got DXY, which is a dollar index. You have the VIX, which is the standard deviation or the volatility index of the S&P 500, and TNX, which is your treasury yields, and what's being offered there are also going to be related too, okay? Well, that's what I've got for you guys for this session on our equities, on our tickers to know, and ETFs. Again, if you guys have questions on how any of this works, or you're still confused, or something I said didn't quite make sense, go ahead, pop into that chat, give me a question, and again, I'll respond as soon as I can and help you make sense of what it is that you're struggling here with. Thanks for listening to me. We've got plenty more to go. But we're building a very, very solid foundation for you guys to understand how these markets work. I'll see you guys very soon. This is Eric signing off. See you at the next one.